Hey traders, and welcome back to another episode of Trade Like Assad. Today, we're diving into the candle range theory, a high-level concept that's been under wraps from most of the ICT trading world, yet holds the power to dramatically boost your win rates. By learning this method, you'll gain the ability to anticipate price moves and candle patterns before they unfold in the market. This game-changing trading framework allows you to align your positions with institutional flows instead of trading against them. So, make sure you stay tuned and don't skip a second of this video. We're not stopping at theory, we'll guide you through the candle range theory with a detailed, step-by-step approach, explaining the crucial elements and principles needed to fully master this sophisticated model. Your continued support means a lot to us, so please hit that like button and subscribe if you're new here. Catch you right after the intro. Welcome back, traders. Let's dive right in. Before we get into the fundamentals of candlestick CRTs, it's important to first grasp the mindset behind candle range theory. So, what is candle range theory exactly? The concept is straightforward. Every candlestick on your chart represents a defined price range. That means a candle on a higher time frame is simply a visual representation of a broader price range. And when you zoom into a lower time frame, that candle reveals detailed price movement within that range. Because price ranges can be swept, broken, or revisited, those same behaviors show up in the form of candlestick patterns. Each candle has a top and bottom, the high and the low. Zooming in reveals how price travels between these 2 points, forming a micro range on a smaller time frame. You've likely seen the market cycle through 3 core stages: accumulation, manipulation, and distribution. Price is always rotating through these phases. Think of it as an ongoing loop that never ends. First, price enters the accumulation phase. Then comes the manipulation, followed by distribution, and the entire cycle begins again. This repeating process is known as the power of 3, which acts like the rhythm of the market. To break it down, price starts in accumulation. This is a consolidation phase where movement is mostly sideways. Next comes manipulation, where liquidity is taken out. Lastly, price is distributed within the range established by the manipulation move. This is where you should start tracking the classic AMD structure, during the Asian, London, and New York sessions. If the Asian session accumulates, it's typical for the London session to manipulate price, followed by distribution during the New York session. Here's a pro tip worth noting. If instead of accumulation, the Asian session shows an expansion move, you shouldn't expect the London session to manipulate. In this case, it's more likely to accumulate, which means New York would then perform the manipulation phase. It all depends on what the Asian session did first. Always assess the Asian session. It gives you the most accurate clue for reading AMD and understanding the market's 3-phase structure. In terms of time frames, the 15-minute chart is the most effective for spotting AMD behavior. It clearly shows price action and syncs well with the higher time frames. With that in mind, let's break down how to recognize a CRT pattern using candlestick behavior. Then, we'll explore various scenarios you might encounter when looking for CRT setups on your chart. For a bullish setup, CRT using candlesticks usually involves a 3-candle pattern on a higher time frame, like the 1-hour chart or above. Here's the breakdown. The first candle defines a range with its high and low. The second candle wicks out the liquidity from that range. The third candle pushes through and breaks out of the range. However, CRT isn't limited to just 3 candles. The model can unfold over more candles as well. The main difference is that 3-candle setups tend to complete faster, but the concept behind them remains consistent whether it's 3 or more candles. Take this example. A range candle forms first, followed by an inside bar. Then, a sweep candle appears that dips below the range using its shadow. After that, multiple candles print until price hits the top of the original range candle. These same ideas are valid in bearish market conditions, too. You can apply the CRT framework across various time frames and to any chart that reflects price action, which helps reinforce everything we've covered so far. Let's explore additional examples of candlestick-based CRT patterns that you're likely to come across in the market. Starting from the top, this first setup is one of the most crucial CRT examples. It holds a strong edge due to its high probability outcome. Why is that? because it neatly reflects the accumulation, manipulation, and distribution phases, all packed into a clean 3-candle structure, representing the complete power of 3. Picture this: we spot a well-defined sell-side liquidity pool sitting just under a bullish candle. The market first drives up, signaling the accumulation stage. Then comes the manipulation. Price takes out the high of the range. Finally, it drops into distribution mode, likely aiming for that sell-side liquidity target. This setup gives a solid directional cue, in this case, a continued move downward. The full AMD sequence is visible: accumulation, manipulation, and distribution, a textbook example of the power of 3. In the next scenario, we start with a range-defining candle, followed by a bullish candle that sweeps beneath the range's low. Afterward, the price produces multiple candles and eventually breaks above the range. Again, we see the range created, liquidity hunted, and a breakout that pushes price upward, back toward the original range high. The next example follows a similar pattern. A range candle forms, but it takes a bit longer for the price to dip below the range's low. Once that sweep happens, the market quickly flips direction and drives toward the range high, closing above it. Each of these patterns plays out consistently with the same logic we've covered: a defined range, liquidity grab, and breakout movement. Now, let's shift focus to the rules and criteria you should follow to spot these high-probability CRT setups in your charts. CRTs, candle range theories, offer a structured and mechanical method to streamline your trading process. They lay out straightforward steps, fixed objectives, and clear-cut rules, eliminating the need for scanning through countless conditions to identify a high-probability setup. The first step is spotting CRT formations near significant price zones. Make sure that the higher time frame candle you're analyzing appears close to these strategic levels in the market. Secondly, timing plays a critical role. It's essential to detect CRTs during key market hours to improve your trade accuracy. Below are the important time slots to focus on in the Forex market: 1 a.m., 5 a.m., 9 a.m., 1 p.m., 3 p.m., 6 p.m., and 9 p.m. When it comes to aligning your entry time frame with the time frame of your CRT, use the following structure. If your CRT setup is based on the monthly chart, use the daily chart for entries. If it's coming from the daily chart, execute your trades on the 1-hour chart. CRTs found on the 4-hour chart should be paired with the 15-minute chart for entries. If your CRT is on the 1-hour chart, then 5-minute or 1-minute charts are best for execution. Finally, when CRTs are identified on the 15-minute chart, the ideal entry frame would be the 1-minute chart. Now let's walk through how to apply the CRT model in real time and leverage it for trade execution. On screen, we've got the Nasdaq 1-hour chart. Notice how the market prints a strong bearish candle at 2 p.m., which is one of our key market windows. I'll mark the high and low of this candle to define the CRT range. Next, I'll shift down to the 15-minute time frame and wait for the 3 p.m. candle to appear. As you can see, the 3 p.m. candle has now printed. I'll go ahead and highlight its high and low as the new reference for the updated CRT range. If you look closely, you'll see the 3 p.m. candle dips below the 2 p.m. hourly candle's low, grabbing liquidity with its wick, and quickly pulls back inside that range. Following this, the price surges upward and eventually closes above the 3 p.m. candle's high. When we zoom out back to the 1-hour chart, we can clearly observe that the 3 p.m. doji has taken out the low of the 2 p.m. candle, validating a CRT pattern that formed right at a critical time slot. This signals a strong possibility that the market, having just completed the manipulation phase by tapping into sell-side liquidity below the 2 p.m. candle, is now likely to move upward toward buy-side liquidity sitting above that range. This sets up a high-probability long entry in alignment with the CRT strategy. Next, I'll drop down to the 5-minute chart to refine an entry point for a potential long setup. On this time frame, we can clearly identify a bullish order block, specifically, the last bearish candle before the price made a strong bullish move that broke above the 15-minute candle's high and closed beyond it. I'll position a buy limit order at the high of this order block, aiming to catch the retest once price returns to it. Now, for take profit, TP, options, we have two viable levels: TP1, set at the midpoint of the 1-hour CRT range, which gives a 2-to-1 reward to risk ratio. TP2, set at the high of the 2 p.m. candle range on the 1-hour time frame, offering a 4.91 R. Let's see how this trade unfolds. As you can see, the price retests the order block, triggers our buy limit, and we're now live in the market. First target hits as price pushes to the midpoint of the hourly range, securing partial profits. Shortly after, price continues its momentum and reaches the top of the 2 p.m. range, hitting our second target and completing a successful CRT-based trade. Now let's break down a textbook CRT model on the EUR1 United States dollar-hour time frame. Looking at the chart, we can see a perfect setup built around the 9 a.m. candle. This candle acts as our CRT range candle, and right off the bat, we can spot all three components of the power of 3. Accumulation, the market starts to consolidate within a narrow range. Manipulation, liquidity gets swept below the range, the price wicks below the low of the CRT candle, grabbing sell stops. Distribution, price quickly reverses and drives upward, breaking the high of the CRT range. So far, this is a solid CRT setup, clean structure, clear liquidity sweep, and movement aligned with market timing, 9 a.m., one of our key zones. Now, let's walk through how we could have actually executed this trade if we were watching the market live. Step 1. Define the CRT range. Start by marking the high, CR, and low, CRL, of the 9 a.m. candle. This gives us our reference range. Step 2. Monitor price action. Once the CRT range is established, watch for a liquidity sweep, a wick that dips below the CRL without a full candle body close. Confirm the price closes back inside the CRT range. This signals that manipulation is complete, and now we prepare for the move into distribution. Downward trend EUR USD CRT model, trade execution breakdown. We've already identified a solid CRT model on the 1-hour chart during a key time, 9 a.m. We confirmed the 3 essential phases of the power of 3. Accumulation, price consolidates within the range. Manipulation, the 9 a.m. candle sweeps below the range, taking out sell-side liquidity. Distribution, a strong bullish candle closes back inside the range. This confirms that a high-probability CRT model has formed. Now, it's time to execute with precision. Magnifying glass step 1, zoom into the 15-minute time frame. To get a clearer view of price action, zoom into the 15-minute chart. Focus on how the 9 a.m. 1H candle played out across the lower time frame. Checkmark as seen here, price pushed below the low of the CRT range during the 9 a.m. window, a key manipulation move. Checkmark after sweeping liquidity, the market reversed and the bullish 15M candle closed back inside the 1H range. This confirms the CRT model is in place and signals that price is likely to continue upward, targeting the high of the 1H range. Brain step 2. Prepare for entry on the 5-minute or 1-minute chart. To refine your entry, zoom into the 5-minute or 1-minute chart. Look for one of the following confirmations: a bullish order block, last bearish candle before the move up. Break of structure to the upside. Rejection from a key fair value gap or imbalance. Pushpin entry strategy. Place a buy limit order at the top of the last bearish candle, 5M OB. Stop loss just below the wick of the manipulation candle. Set take profit 1 at the midpoint of the 1H CRT range, 2 to 1 R. Set take profit 2 at the high of the CRT range, up to 4.9, 1 R. Now that we've zoomed into the 5-minute time frame, it's time to lock in the trade. Pushpin entry point. I placed my buy limit right at the highest point of the 5M order block, which is the last bearish candle before the bullish move. Downward trend stop loss, just a couple of pips below the order block, keeping the risk tight and calculated. Bullseye take profit options. We've got 2 smart targets: midpoint of the 1H CRT candle, more conservative, giving us a solid 2 to 1 R. High of the 1H CRT range, for those going big, this gives you up to a 4.9, 1 reward if the setup plays out fully. Checkmark as shown, price tapped into the order block, respected the level, and pushed cleanly toward the high of the CRT range, executing a textbook CRT trade. Speech balloon final words. That's it, traders. We just walked through a perfect CRT model, from higher timeframe identification to lower timeframe execution, all following clear rules and fixed objectives. Brain, keep it simple, stick to the process. The CRT model works, if you work it. Thanks for watching. I hope you found this video informative and valuable for your trading journey. If you did, don't forget to hit that subscribe button and turn on notifications so you never miss our latest strategy breakdowns and market updates. We truly value your feedback. Drop a comment below and let us know what you think of the CRT model. What topics you want us to dive into next. Your suggestions help shape this channel and keep it fire. Thanks for the support, and I'll catch you in the next episode. Until then, trade smart, stay disciplined, and always trust the process.